Dear students, welcome you all to session 1 video of Financial Management 6th semester BCom of Mangalore University. During the 6th semester, the subject which you are going to study is Financial Management 2nd, which is a continuation of the subject studied in the 5th semester. The 6 chapters are Treasury Management, Working Capital Management, Cost of Capital, Dividend Policies, Mutual Funds and Financial Statement Analysis. Out of these, the first 4 chapters relate to the decision area of the financial manager, and then you have the 2 more chapters, the 5th one which is about the mutual funds, and the last chapter is analysis of the financial statements. So I begin with the second chapter, that is working capital management. The various decision areas of financial manager are the investment decisions, financing decisions and the dividend decision. Investment decision is the decision to invest the funds in various assets. So the assets may be either fixed assets or current assets. When it deals with fixed assets, we call it as capital budgeting, and the investment decision relating to current assets is known as working capital management. So we are going to study in detail about this working capital management, which is actually the management of the current assets and current liabilities. The other decisions are the financing decision, that is the decision relating to the various sources of funds, as well as the dividend decision, that is the decision relating to the payment of dividends to the shareholders. And now the current assets as well as the current liabilities. Let us understand the meaning of these two. Now current assets, we are all familiar with current assets, and current assets are the assets which in the ordinary course of time can be converted into cash within 1 year without interrupting the the production activities of the business, or without incurring any loss. That is known as current assets. Now we also have current liabilities. These are the liabilities which are intended to be paid in the ordinary course of business within a year out of the current assets or earnings of the firm. So these liabilities must be paid within 1 year, an accounting year. It must be paid either out of the earnings of the firm or out of the current assets or cash. Now the different current assets you may be aware of, that is we have cash, we have debtors, bills receivable, marketable securities, the stock of goods, and the various current liabilities like the bank overdraft, creditors, etc. Now working capital management is about managing the current assets and current liabilities. So just as how important capital budgeting is, that is management of fixed assets, in the same way working capital management is also very important. Why? Because if the day-to-day operations of the business and the efficiency of the business all deals with the efficient working capital management in an organization. Now there are certain terminologies which we need to understand. The first one is the gross working capital, which means the total. So the gross working capital means the total investment made by the firm in the current assets. So the gross working capital means the total investment made by the firm in current assets. That is the total of the current assets, we can call it as the gross working capital. And we have a net working capital. Net working capital is the excess of current assets over the current liabilities. It's always better to have more current assets than the current liabilities. So net working capital is current assets minus the current liabilities. It is actually that portion of the current assets which is financed by long-term liabilities. So we have net working capital which is equal to current assets minus current liabilities. Other than this, some other terminologies we look into is the permanent working capital. Now it is the working capital which is needed throughout the year, the minimum amount of current assets which are to be kept by the firm for the entire year to ensure smooth running of business operation. Now a firm will have to maintain a minimum level of current assets throughout the year in order to continue with the business operations. That is called as permanent working capital. At the same time, we have a concept called temporary working capital. That is, these are the the additional current assets which are required in order to meet the changes in the business. Now for example, there is sudden increase in demand for a product, so extra current assets or stock of goods have to be maintained. That is called as the temporary working capital. So the concept which you have understood is first one is the gross working capital, which is the total investment made by the firm in current asset. The next one is net working capital, which is nothing but current assets minus current liability, which means the excess of current assets over the current liabilities. Then the permanent working capital, it is the working capital which is needed throughout the year, the minimum amount of current asset which must be maintained by the firm in order to carry on the business operation in a smooth way. We call it as permanent working capital. And we have temporary working capital, it is the additional current assets which is maintained to meet the changes in the business during the year. Okay, thank you.